Kia ora and welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Rebecca Stevenson. I'm Senior Journalist at BusinessDesk. And today on Shared Lunch, it's time to look at our quarterly Investor Insights survey and get a pulse check on the property market with independent economist Tony Alexander. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Tony. Now, today we are going to talk about your investment survey, which garnered more than 800 people's views on investing, what they want to invest in, and their appetite for investment. Shares. Now, let's start here because despite the turbulence that we've seen in markets, the survey showed that the most favored asset to buy are shares, with 58% of those people surveyed saying they would like to add more to their investment portfolio. What do you think is driving that interest in buying shares?
Yeah, well, I think this is the sort of the big consistent result of the survey over the period that we've been doing it. People consistently are focused on the long term with their portfolio investments. These aren't the 1980s reef fish jumping around from one thing to another, not even one share to a different share, a different, government corporatized, corp sort of SOE thing. People are very much focused on managed funds, some buying individually for sure, but people have this long-term focus, maybe reinforced by the whole Kiwi saver and how people are aware of that long-term focus, but people are saving for the long term and are not flip-flopping around all over the place.
So that's probably quite a pleasing and sort of sophisticated, take on share investing that you're seeing.
Yes, it challenges the view often that maybe some politicians or policymakers will have that people too quickly move from one thing into a different thing, especially if we're talking, say, residential property. There's a view that, these are just all property flippers, people are in it for the short term. Well, no, the evidence that is that the overwhelming majority of people in residential property are there for the long term, and the same when it comes to shares, either buying directly through a managed fund, through an exchange-traded fund, or whatever. So yes, much as we say we Kiwis are focused on the short term when it comes to providing for retirement, no, there's a good long-term focus, just as there is with people overseas.
Yeah, it's kind of interesting as well because on the flip side of that equation that we saw in the survey was more people did say that they perhaps would look to sell shares. A little bit of a rise there with 16% saying they'd look to divest some shareholdings. What do you think is making them look perhaps at selling now?
Oh, I think there's a lot of things in play. We are in a rapidly changing world where people are seeing the rise of AI, for instance, so wondering how could I get maybe some exposure to that? I don't know about in New Zealand, but maybe overseas. We see strong demand for particular minerals coming through, rare earths, and people are looking at a technological revolution, the greening of the world economy, thinking about, well, how can I get exposure there? There's also at the margin people who might be thinking, well, the El Nino weather pattern is not so good for the farming sector, so maybe for a while I'll re-weight a little bit away from agricultural primary sector focused stocks towards other sort of stocks out there. So I think certainly there's just some people reacting to some of the changes we can see in the broad economic operating environment, and I certainly don't get a feeling coming through from the survey that people are giving up the ghost entirely and thinking that there's a crisis out there and the best thing you want to do is cash up. No, just some small changes at the edges.
Interesting, isn't it? Because again, you also ask people, you calculate that net asset purchase intentions. That's adding together those who want to buy and those who want to sell. Shares were still out in front in terms of being the favoured asset to buy, along with managed funds, savings account, and exchange traded funds. What did you glean from that, and what might it tell us about the wider economy and investor sentiment?
Yeah, for the wider economy, there's a lot of caution which is still sitting out there, I think. And for some of the managed funds, the returns haven't been what people were expecting. And especially with interest rates at high levels and going up higher recently, some people have seen better returns on maybe the fixed interest deposits going into that sort of area. So maybe that accounts, in fact, for a bit of a decline we've seen in net intentions of investing more in managed funds, ETFs, buying shares directly, etc. In fact, the net proportion there dropped from about 93% to 73%. So still very high, but I think just that increase in interest rates has had a bit of an impact out there. Not necessarily some fresh deterioration in view on the economy accounting for that decline. And looking at the history of the series, they could easily bounce back up again. And maybe it will with a change in government. We've got, I think, a new, stronger focus on economic outcomes in New Zealand over the medium to long term in particular. So maybe that is going to have some sort of an impact, which we might be able to pick up in the future surveys.
And you also did ask people how they're buying their shares. And so what does that tell us about, how our shareholders are getting into the markets?
People are showing a bit of a trend over time towards using apps. I think the big change there might have been 2-3 years ago, clearly, with the pandemic and people being locked down and looking for something to do with their time and their money. Given that the $10 billion we Kiwis would normally spend travelling overseas, we couldn't spend that money, so we'd look for something else to do with it. And once we'd bought spas and kayaks and a few electric bikes, people decided to invest in a few other things out there and looking at undertaking it themselves. And so going through an app is increasingly popular, I find, out there.
Interesting, because I guess a lot of this kind of response does speak to perhaps people becoming more familiar with investing in shares getting maybe a little bit more sophisticated and a bit more confident. How do you see that kind of playing out in New Zealand?
Yes, I think there's already a good level of confidence about investing in shares. People have actively traded the share market in New Zealand. I can certainly recall back to the 1980s and the frenzy, which was a bit too much going into the crash in about October or so of 1987. I think the familiarity definitely is there, and especially with the younger generation coming through from, I guess, two sources. Number one would be the availability of the share trading buying, selling apps coming through. And of course, with KiwiSaver as well. My advice to all young people is get yourself set up in KiwiSaver as soon as possible. You can obviously build towards your retirement savings, but also build up a deposit quite well towards making your first house purchase, if that's the route that you want to go down. So put that in conjunction, maybe also with the increasing bit of a focus in the schools on entrepreneurship, on running mock businesses, etc. The newspapers always have examples of senior high school kids setting up, an ice cream marketing business or something like that. I think there is a good level of awareness out there of running your own business, and obviously also investing in shares for other people running businesses.
Yeah, now you've mentioned the big bopper, of course, in our economy that we talk about all the time, with people maybe using KiwiSavers for house purchases. Property is a bit of a national obsession. We often joke, that we've got a housing market with some other bits tacked on. And you did ask some people about that, and there were some interesting little tells perhaps in this survey. So I'd love to know, what was your biggest takeaway for the housing market out of this sentiment survey?
Yeah, the biggest area there, if I have a look at net purchasing intentions on residential property, I've still got about a net 8% of the investors saying they're going to put some more money into residential property. But if we go back to the same time a year ago, that was sitting at a net 16%. So from the survey here, I can't see evidence that all of a sudden people are looking to switch back to residential property investment. Obviously, because this tends to be debt funded in New Zealand, with interest rates A being high and B having in fact gone up pretty much all of this year, apart from one bank cutting just a few days ago to a small degree. The numbers don't stack up for a lot of people when they're looking at it from an investment point of view. From a house that I will live in and raise a family point of view, that's something different. If we look at the data, for instance, from CoreLogic, they show that on average, 21% of house sales in New Zealand go to first home buyers, and recently that was running at a record 28%. So people, the younger people, I think, have been taking advantage, obviously not of low interest rates, not of high credit availability, but the absence of investors in the residential property market to, in fact, make a purchase. So in some regards, that has been a pretty positive thing to see over the past 12 months. And the thing most of us are interested in now is trying to get a feel for change in government, return of interest expense deductibility earlier than any of us were expecting. Will we see a rush of investors back into the market? Personally, I don't think so. Not again with the interest rate so high and costs for other things going through the roof.
Yeah, interesting. Interest rates really do kind of rule supreme at the moment, don't they? Can we talk a little bit now about commercial property, because that has been a really sort of strong and favoured investment for quite some time. Obviously, it's now been taking a bit of a hammering for a number of reasons, and this survey showed another decline in investing appetite. What are the factors that are particular to commercial property that are dampening investor enthusiasm?
Yes. You see, on average, I've had over the period of time for the survey a net 10% of people saying they're going to buy more commercial property. We're running at just 5% at the moment. So, in fact, that is the lowest since I started different versions of the survey back in late 2021. And I think there's a number of things here. The key thing would be the high level of interest rates. When interest rates go up, it tends to depress the prices which people are willing to pay for commercial property. We've also seen a frenzy of buying, especially for industrial warehousing property. The yields are exceptionally low, and it's a big call, I think, for many people to justify buying some more of those types of properties when they can get better returns for minimal risk by simply investing in fixed interest securities, for instance. So that'd be one thing out there. But also, I guess, some key uncertainties, for instance, working from home. What's going to be the average going forward for the proportion of people who were working in offices and CBDs, etc., going back? We see efforts by some large corporates around the world to try and get people back into their offices, making bonuses dependent on being at work at least 3, maybe 4 days a week. Where are things going to settle down? Don't know. How does one factor in the fact that, for instance, in Auckland, it's very difficult to get premium level office accommodation, but that's because people have shifted out from the C, the D, maybe the B grade stuff into the A grade stuff. So there are some definite tiers that are appearing out there with regard to the office accommodation. If you're looking at retail, frankly, it's a bit of a mess. We have consumer confidence, which is really low. Well, more accurately, consumer pessimism is really high. We have people pulling back on their spending and likely to continue to do so for the next 12 months. And retailing is also exceptionally challenged out there. So I think for your average commercial property investor, and let's not forget earthquake strengthening requirements as well. It's become a bit difficult to see the wood from the trees of investing over that medium to long term there. So maybe some people just stepping back for a while, but I still think there's a solid level of demand out there. But the interest rates for the moment, putting a few people on hold.
Yeah, it's really interesting. I really don't know where it's going to end up. I think you're spot on there, with the work from home factors, plus all of that sort of weakened demand. It's kind of looking like it's going to be rugged for a while. Speaking of rugged for a while, there's quite a chunk of your survey which looks at how investors are feeling. With survey respondents asked whether they're worried about their investment returns and what is causing them the most concern for those returns. What are people saying now, and how does that compare to other surveys that you've done?
Yeah, well, the things that are most concerning the investors at the moment sort of make sense in terms of interest rates. I mean, the intent of the Reserve Bank of raising interest rates is to cause pain for consumers, for businesses, and therefore reduce profitability, reduce dividends, maybe downward pressure on share prices. So worries about interest rates are top of the list there. So that certainly makes sense. Inflation, that's sort of second there. Well, that's really related to the interest rates. Personally, high inflation, high cost of living increase, it hits all all the families out there one way or another, and it rolls into concerns about interest rates out there. So rate levels highly relevant to where asset returns are going to go. Third, you've got general geopolitics is what people are concerned about. If we look to the previous survey, people were showing concerns not so much about geopolitics in terms of a world sense. So that's what I mean by geopolitics there, the international political situation, obviously the war in the Middle East, Ukraine, a little bit about China, Taiwan is in there. Previously, we had huge concern about the government in New Zealand. People concerned, I guess, about the policy mix, about the direction the government seemed to be going in, the lack of focus on the economy as well, and just a feeling of there is a need for change, but not confident necessarily that there would be change at the election. And so with the change in government confirmed from the October 14 result, people are switching back to focus on the more traditional concerns rather than, I guess, the diversion of worries about whoever's in power.
All right, if you don't own a house, you probably want one. And if you own one, you want to know what it's worth. And if you're selling, you're very keenly aware of what is going on or not with the housing market. What is your sense, Tony, of where the housing market is at the moment? And I would love to hear your predictions as we come into summer and that expected busy selling period.
Yes, my view on housing there's sort of two angles I'm coming from. The first angle is the long-term macroeconomic fundamentals of supply and demand. And this is sort of the space where us economists live, this sort of area. And what we see, of course, is with record net migration inflows, so strong population growth, especially in Auckland, demand for housing is rising firmly, be that rental accommodation or for other people, go and buy the house to live in. Yet at the same time, the supply of housing is falling. So construction, it's still at a high level out there, but the new houses coming onto the market becoming fewer and fewer in number as people have pulled back from ordering a new house and instead have looked at existing houses, listings, etc. Demand going up, supply going down, it's inevitable that places upward pressure on prices. And my view is that eventually we get some momentum developing in the market. People look at their supply and demand curves, remember the Economics 101, and they will feel more motivated to make a purchase. And I think through summer, there will certainly be elements of that for the first home buyers, that they can feel that maybe their window of opportunity to make a purchase is closing with the investor tax rules changing. So I do think the first home buyers are still going to be out there. Their difficulty, of course, is getting the credit. There's a lot of hoops to jump through. And that sort of takes me to the other way I look at the housing market, and that is more the short term. Do I do it now or do I wait a few months? And while I think for the first home buyers, there's a feeling of, I'd better get in relatively soon. For the investors, I don't think that there's any feeling of I need to make a purchase as soon as possible or I will miss out. I cannot see that FOMO, fear of missing out, is just straight lining upward at all. The investors, the interest rates are relatively high. They are deeply concerned about rapid increases in costs for maintenance, for insurance, for council rates, etc. And the numbers simply don't stack up for many of them. So I think the market is still going to be rising, basically month to month as we go through summer. But I don't think we're looking at a frenzy. But what will change maybe will be late in 2024 when there's more downward momentum on the interest rates. That's when I think things will change. That's when more people will feel it'll become a matter of moment to make a purchase before other people make a purchase. And so I'd say summer, there's strength, but there's no frenzy. But slowly as we get through 2024, I do believe it's going to get busier. And there's two things I'll keep a close eye on. Number one, interest rates and exactly what they are doing. And number two, the stock of listings. Once they start falling away, then people get nervous, then things will start moving. And that maybe will really manifest itself in 2025.
So we've got an announcement again this week with the Reserve Bank around interest rates, and it did decide to hold. How do you see that flowing through into the property market?
Yeah, basically there was 100% expectation in the markets the Reserve Bank would do nothing, principally because they need to see solid evidence of the easing in the labour market leading to wages growth slowing down, and we don't have that solid evidence yet. And they need to see more solid evidence of business pricing intentions pulling back. The direction is right, but it's still way too slow. So what that means is that we could easily see some further fluctuations in the fixed mortgage rates people face, but not really because of developments here in New Zealand. It's going to be more if the inflation worries return in the United States, then their interest rates will go up. That'll lead to increases in interest rates back here in New Zealand. But if we get the most recent developments in the past 5 weeks of, the outlook is okay for inflation in the US and funding costs have come down, then we could easily get some further downward tweaking to the fixed interest rates for especially 2 years fixed and beyond, and maybe the 1 year fixed rate as well through summer. So frankly, with 3 months now until the next cash rate review, the domestic scene, as it were, is going to be relatively quiet, but we could still get this uncertain movement up or down coming out of the United States. For most borrowers, the incentive is probably still to have a view, the Reserve Bank's going to ease, but I'm not sure when. Maybe I fix 12, 18, 24 months.
Now, let's talk a little bit about renters. What is your view on how the sort of housing market changes or not, is going to play out in terms of rental prices?
Yeah, I would expect rents are going to continue to rise for a number of reasons. Number one, the costs of running a rental property, of having that as your asset, your investment, are going up all the time, with the local authorities, the council warning that their rates need to rise 12%, 20%, whatever it's going to be. That's a big cost if you're owning a property, whether as an investment or the place that you live in. The maintenance costs, of course, are rising all the time. And then the insurance costs. A lot of people are in for a nasty surprise in the next few months when they get their new premium requirements for car insurance, contents, structures, etc. Big increases out there. So the costs are rising. That will start to feed through into the rents, but also the demand for rental properties is rising really quickly. We've got the return of international students. We've got migrants, workers coming into New Zealand as well offsetting the net loss of Kiwis, about 45,000 overseas, especially to Australia. So yeah, the direction for rents is going to be continually upward over the next few years. A lot of pressure up there, and that's going to make it more difficult, I think, people who are actively looking to rent, and so they'll look for cutbacks in some other areas. But it also means that for some young people who've been dithering a bit, extra incentive to accelerate their property purchase through 2024.
And on the flip side, you've spoken a little bit about, investor demand perhaps being suppressed. At what point do you think that those enticing high rental prices will perhaps lure some investors back into that side of the market?
Yeah, that's always a difficult thing to say. When do the numbers switch around and people go, actually, now this is going to be quite a viable investment to undertake? Wouldn't have the foggiest. You see, we have the costs going up, we have the rents going up, but historically, much as I've emphasised the cost pushing rents higher, not everybody prices to necessarily get the maximum rent they can. There are limits to how much pain most landlords want to inflict on their tenants out there, so those cash flow returns are going to be relatively constrained for a while. If I had to pick a trigger, it would be interest rates falling quickly. And with the return of interest expense deductibility, that's going to be a positive thing. So for me, if we are to see investors running through the numbers and going, well, this is now a pretty wise thing to do, it's going to have to require interest rates falling about 1%. And that's not something that's likely until maybe late 24, maybe early 2025 for those who are heavily reliant on debt financing.
Tony, tell me, what are your thoughts on the outlook for the economy overall?
Yes, this has been obviously a huge area of uncertainty for some time, especially ever since late in 2021 when the Reserve Bank said, or 2022, we may be looking at recession in the New Zealand economy. Their comments definitely had a strong impact on consumer and business sentiment. Everybody got really depressed. We could see the big weakness in consumer spending, in particular out there. But as we look forward through 2024 into 2025, we've still got some big negatives, but also some positives. That the negatives would clearly be the weakness in China's economy. China takes 1/3 of our exports. what happens over there really matters back in New Zealand. And with the Chinese families rebuilding their household wealth by increasing their savings, they're not eating out as much, therefore consuming New Zealand's food export commodities in particular. So that has fed through to weakness in prices for the red meat, for some of the fishing products, obviously dairy products, but also wheat construction, so hitting the forestry sector as well. On top of that, hitting New Zealand's primary sector, we have the El Nino weather pattern, drought highly likely in the east coast of North and South Island. So farmers basically closed their wallets on their discretionary spending in New Zealand about 4 months ago. The high interest rates explicitly aimed at crunching the economy. That's another big negative out there, and worries about the world economy as well. And the cost of living increasing 20% plus over the past 3.5 years. That's made life difficult for a lot of people and constrained their spending. But we do have positive developments running through the economy, such as the return of international tourists. At the moment, we've got numbers at about 86% of what they were late in 2019, and scope for further growth there, especially when the Chinese return. But let's maybe put that 12 months down the track. The foreign education sector bouncing back as well. So the students coming into the cities, Auckland in particular, making a bit of a difference there. Wages growth actually exceeding the cost of living increase. The trouble there is not everybody's getting a wages growth, a decent wage increase, but some people are. So there is some support for certainly some areas of consumer spending out there. There's still rebuilding to be done from the bad weather events of early this year. Lots of infrastructure spending to be done in New Zealand. It's no point saying in the coming 1, 5 or 10 years, we're talking the next century here for so much to be done in New Zealand. And so that's also going to provide some underpinning to economic activity. But overall, and unfortunately, I still find myself on the weak side there, especially when we acknowledge the new government will be tightening fiscal policy, so looking to cut government spending where possible to, pay for the tax cuts, and also decreasing house building through to late in 2024. We're still looking at reasonably weak growth in New Zealand's economy in 2024, maybe 1.5% if you're lucky. But in a way, that's sort of positive because it's going to set the scene for the Reserve Bank to eventually ease monetary policy to a good degree from some point in 2024. When exactly might they do that? Well, ask me once they've done it, because none of us has had a great interest rate forecasting record for quite some time now.
So just to recap, what is the one key takeaway from today's episode that you think investors need to know?
Look through these short-term fluctuations in the economy, in our society, the world economy, etc., and remain focused on the long term, because when you maybe were introduced to equities for the first time, somebody would have shown you a graph looking at the returns on a diversified equities portfolio, maybe starting back in 1926. That seems to be one of the popular ones out there, and the graph moving upwards over time. But you've got to look closely because there can be some big blips downward, but eventually the graph continues going upwards. So remain focused on the long term, whether it be looking at your KiwiSaver or just your non-KiwiSaver managed fund or share purchases, but just be aware you will be challenged along the way by new uncertainties, climate change, AI, war in the Middle East, oil price uncertainty. Try and stay the course and don't end up like some unfortunate people when the pandemic first came along in 2020, sold out because they hadn't seen one of these disturbances in the graphs before, and they sold out and they missed out on the recovery. Keep focused on the long term.
Yeah, I find just not checking actually works really well in terms of keeping me not worried. Hey, thank you so much for joining us today, Tony, and thank you everybody for tuning in. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a 5-star rating and comment, please, with who and what you would like to hear about. We have a special offer for Sharesies investors from BusinessDesk. If you use the promo code Shared Lunch 2023, you can get $100 off an annual subscription to BusinessDesk. This offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. Enjoy the rest of your week.